Hello everyone, I just finished recording this episode, Top 5 Retirement Planning Mistakes, and guess what? I actually realized I made a mistake in the recording of it, so I wanted to give you an update before you got into it. In this episode, I'm going to talk about required minimum distributions. Now, a required minimum distribution is something that you're going to have to take out of your account at age 72 from your traditional IRA and your traditional 401ks. The mistake I made is that I said that you do not have required minimum distributions in a Roth 401k. That is not correct. There are required minimum distributions in a Roth 401k. There are no required minimum distributions in the Roth IRA. And so I made a little mistake there. I wanted to make sure everyone that listens to this episode heard that first, and I'm going to hit pause in a second, put this at the beginning of this podcast episode, then you're going to be able to listen to the rest of it. But again, the mistake I made was saying that there's RMDs on a Roth. There are no RMDs in a Roth 401k. That's not right. There are RMDs in a Roth 401k, no RMDs in a Roth IRA. Hope that clears it up. If you have any questions about that, email me at scott@forthrightfinances.com just so we can clear any mistakes. I hope you enjoyed today's episode. Bye. Hello, welcome back to Retirement Clarity Radio. I am your host, Scott Newhouse. I'm a certified financial planner. I'm an author of 3 books on retirement planning, and I'm an all-around good guy. I really appreciate you being here. Shout out to the dozens and dozens of listeners all across the country listening in. I appreciate you being here. If you are new to the podcast, just to give you, get you up to speed, this is a short 10 to 15 minute podcast series where I just give you what you need to know about a specific topic. We go high level and then we get on with our day. We're not going to be here 30 to 40 minutes. We're not going to be here an hour. That's way too long. Just going to get you what you need to know, and then we're going to go on with the rest of our day. So today's episode is going to be on the top 5 retirement planning mistakes that I see. And so let's just dive right into it. So you've worked hard for 30 plus years, hoping to enjoy your retirement. Maybe you've done a really great job of savings, investing, and you're really ready to call it quits and go on to this next stage of your life. But if you make certain mistakes, and we'll get into them, your so-called golden years may not be so golden if you make these mistakes. So understanding how to plan for retirement and the mistakes to avoid is so important so that you can have a stress-free, comfortable retirement. So let's get into our top 5 mistakes. The first 2 actually relate to taxes, but they're a little bit different. So the first mistake I see people making is they don't plan for taxes. They don't have a strategy for their taxes. A lot of people think that planning for taxes is all about lowering your tax bill on April 15th of every year. And so the focus there is that is really the taxes that you've paid for the current year, minimizing your liability in that year as much as possible. But my question is, well, what about your taxes in retirement? Yeah, you might be focusing on the year-to-year taxes, but what's your long-term 5 to 10 to 15-year tax strategy? It's a mistake that a lot of people make. They've got a strategy, they've got thoughts about how they lower their current year tax bill, but they're not thinking decades ahead, and especially they're not thinking about taxes in retirement. I'm just going to bring up a couple points here. You might have an IRA or a 401k in a traditional account, so you defer money in the current year, lowers your tax bill in the current year, and then you're going to have to pay taxes later. But some people aren't aware that they're going to have to take out that money at age 72. That's something called a required minimum distribution. We won't go into too much detail here, but essentially the government wants you to take out a percentage of that account every year so that they can start getting some tax revenue from it. And you'll have no control over how much you withdraw because the government sets those percentages. And it starts out low, but then it goes up every single year. So what's your strategy to make sure that you're not taking out too much when you get to RMD age? Once you get to age 72, what's your plan to make sure that you're not taking out so much that it's going to bump you up into some kind of higher tax bracket? So that's one thing to think about in terms of planning for your taxes. Another thing to think about is the taxes that you might have to pay on your Social Security benefits. Your Social Security benefits might be taxed all the way up to 85% of the benefits that you receive. And I've talked about that in a prior podcast episode. But what's your plan for paying less in Social Security taxes when you start claiming those benefits? The third thing that people don't plan for, and that I think they really need to, is they need to have a plan for what if taxes rise in the future. And I'll talk a little bit more about that today, and I've definitely talked about that on a previous podcast episode. But what's your plan for, if some politicians get in power and they raise our income rates, our tax rates? Did you take advantage of the lower rates that we had before? And I actually wrote a book about this. The book's called The Retirement Tax Bomb: How to Protect Your 401k from Impending Tax Increases and Create a Tax-Free Retirement. This book's available on Amazon, but you actually don't need to give Jeff Bezos any more money. He's actually doing fine. So if you want to get this for free, you can go to freeretirementbooks.com. Again, that's freeretirementbooks.com, and then just click on the Retirement Tax Bomb: How to Protect Your 401k, etc. And then you'll just give me your name, email address, and then you can get that whole book PDF download for free right away. So that's my main number one point of retirement planning mistakes. Most people don't have a plan for their taxes. Not that we can always pay a 0% tax rate in retirement, but we can plan to pay less in taxes if we are proactive and if we actually have a tax planning strategy implemented. The second retirement planning mistake that I see people make is that they actually don't understand the tax benefits of different retirement accounts. And so this is obviously similar to the previous point, but it's a little different. So each investment account has different tax benefits. And so what you need to do is you need to weigh the pros and cons of paying taxes now versus paying taxes later. And so obviously you can lower your taxes in the current year with things like a traditional 401k, traditional IRA, and then you can also invest in something called a Roth IRA, where you do have to pay taxes in the current year, but you won't have to pay taxes in the future. So you really need to weigh the pros and cons of, where do I want to put my money, and where's it going to make the most sense for me? So let me dive into kind of how it works. There are three main tax buckets. And so you can have your money in three different taxable type of investment accounts. The first one is our taxable investments. This is like a brokerage account, an individual account, a joint, account that you might have with a spouse. It's a non-retirement account. You pay taxes every year on any gains. It could be at the capital gains rate, or it could be at an ordinary income rate, depending on how long you've held the investment. So, and you can also put in as much money as you want into those accounts. There's no restrictions there, and you can withdraw it without any penalty at any time. You just might have to pay some taxes on it. And that's our taxable investment accounts. Our second tax bucket is tax deferred accounts. This is where most people have most of their money. This is in your traditional IRA, your traditional 401k. As the name suggests, tax deferred, you pay taxes on it later. When you make a contribution, it can lower your income in the current year, but when you withdraw the funds during retirement, you pay taxes on the amount that you withdraw at whatever your tax rate is in retirement. And obviously you don't want to take it out early, because then you might have to pay some penalties on that, and we'll get into that in one of my next points. But the problem with too much money in tax deferred accounts is that you have all your eggs in one bucket, and you're going to have to pay taxes whenever you withdraw that money, and that's kind of going to be up to the government to determine what they want the tax rates to be in the future. Our third tax bucket is tax-free accounts. So your Roth IRA, your Roth 401k, or even something called a health savings account, an HSA, these are all examples of tax-free accounts. So unlike the traditional IRA or 401k, you do not get the tax benefit in the year that you contribute, but your contributions and your earnings grow tax-free. And then when you withdraw the funds, you don't pay any taxes on them because you've already paid taxes on the year that you contributed. Also, a really important point is that Roth IRAs and Roth 401ks do not have the required minimum distributions that I mentioned before. So you don't actually have to take money out of the Roth IRA accounts if you don't need it, or the Roth 401k accounts. So you don't have to worry about the RMDs on that portion, since you've already paid the taxes. Now, in terms of tax planning works best when you put your money in different tax buckets. So I encourage you and all of my clients to have money in taxable accounts, tax deferred accounts, and tax-free accounts. And that's what that's going to do is it's going to give you added flexibility of where to withdraw money from at certain times. For instance, if your tax rates are lowered temporarily, like they are from 2018 until 2025, when the Trump tax cuts were signed into law in December 2017, it knocked down individual tax rates from 2018 until 2020 until the end of 2025. With those lower tax rates that we have now, it might make more sense for you to take money out of tax deferred accounts since we have lower tax rates. However, if tax rates are increased, which I think is likely, then it might make more sense for you to take money out of accounts that have already been taxed so that you don't have to pay that increased tax liability. And so my main point here with these different tax buckets and investment accounts is to practice something called tax diversification, giving yourself the option to withdraw money from accounts when it makes most sense to do so. And again, the main mistake I see here is that most people don't have as much in the tax-free accounts as they should, and they really have most of their money in either one bucket or at most two buckets, but they don't have enough money in all three buckets. And so that's our second big mistake. They don't really understand and practice tax diversification. Our third big retirement planning mistake is not taking full advantage of your employer's benefits. And the main things that I see here are 401k match, HSA, the health savings accounts, and then also some like fringe benefits. Sometimes an estate plan is offered, and we'll get into those right now. So there's so many different ways to save for retirement, but it's really a no-brainer to take full advantage of your employer's 401k match. So for instance, if your employer matches 3% of your salary dollar for dollar and you make $75,000 a year, that's $2,250 in free retirement money if you contribute at least $2,250 per year. So it's just a dollar for dollar. A lot of companies offer a dollar for dollar match up to that 3% limit. And so that's a free couple grand that you get just for contributing. So really make sure that you're taking advantage of that employer match in your 401k. Another option is actually the employer 401k and the employer Roth 401k. And many employers offer this option, yet a lot of employees don't understand the difference. So that Roth account and does not give you the tax rate in the current year, but once you put the money in, it grows tax-free, and then you can actually take it out tax-free since you've already paid taxes on it. And so most people make, again, and I said this before, the mistake of putting all their money in tax-deferred accounts when really we want to have a balance between all three. And so that Roth 401k is a great option if you don't if you can't get money into the Roth IRA, because with the Roth 401k there are no income limitations, whereas with the Roth IRA there are income limitations. So if you're not eligible for the Roth IRA because your income's too high, you can contribute to the Roth 401k. Another employer benefit that I really like is the health savings account, an HSA. So any money that you contribute to an HSA is before tax, so it lowers your taxes in the current year, and then it grows tax-free, and you can actually invest it. And then when you take it out for qualified medical expenses, the distributions are tax-free too. So there's a lot of great benefits on the health savings account if you have a high deductible plan. And high deductible plans don't make sense for everyone, so you got to do your due diligence, but it can be a great way for you to save money in the future, a health savings account offered through work. And then lastly, I've actually seen some employers offer discounts on estate planning services, and lawyers are very expensive. So if your company might offer to split or completely cover the cost of creating a will, a trust, power of attorney, I highly recommend that you take them up on it. Okay, so making full use of our employer's benefits, or not making full use of your employer's benefits, that's our third retirement planning mistake. Our fourth one, and we're wrapping up here. I know we might go a little over 15 minutes, which I don't like to do, but bear with me here. Our fourth retirement planning mistake is over-reliance on Social Security benefits. So Social Security could cover up to 35 to 40% of your past income. And so right now, on average, retirees earn around $18,170 per year from Social Security. The chances are, though, that you can't live on an amount that's small, even if you don't even have a mortgage, even if you don't have any other debt. That's just not enough money. And so the problem that I see is that we have too many retirees in our country that are over dependent on Social Security. And so really what we need to be doing is we need to be focusing on how do we create assets and investments that are going to cover that extra that we need to provide the income that we need in retirement. Also, as we all know, the Social Security system just isn't stable. I talk about this in my book, The Retirement Tax Bomb. Social Security is basically made up of a trust fund that they're depleting every year because we just don't have enough workers to pay for all of Social Security through taxes. And then the second part of Social Security funds comes from payroll taxes. So everyone that's working, pays into the Social Security system, and Social Security gets their benefits from those payroll taxes and the trust fund. Problem is the trust fund's depleting, and we're gonna run out of money in that trust fund at some point in the 2030s. That changes every year. But my main point here on Social Security is that, even if you have a decent amount of Social Security income, we can't be overly reliant on that because the system isn't stable, and frankly, I don't think our politicians are doing a good job of figuring out how to stabilize it. So we just can't be over reliant on our Social Security benefits. Although it could be a nice boost, we just don't want to be overly reliant on Social Security or expect it to always remain the same. So I really encourage people to have to beef up their investment accounts prior to retirement so that they can have a much more stable, secure source of income in retirement, in addition to Social Security. The next biggest mistake that I see people make, and sadly I see too many cases of this happening, is cashing out your 401k or your IRA early. So changing jobs, some kind of financial crisis at home, or even buying a home. It might seem like a good idea to cash in the money that you've saved into your 401k or your IRA, but I really don't like that idea. An early withdrawal before the age of 59 and a half incurs a tax penalty of 10%, plus you're actually going to owe income taxes on the amount that you withdraw as well, since you haven't paid taxes on it before. And then also, if you take out a big amount, that could push you into a much higher tax bracket. So there's just a whirlwind of bad things that could happen if you take a big distribution out. Especially if you take it out early. I've actually seen cases people wanted to pay off a home and they take out a few $100,000 all at once, all in the same year, early from their retirement accounts, and it caused a lot of stress and damage in their life. So I really don't recommend taking out it early for all of those reasons. Whew. Okay, we did go over. I deeply apologize for that. Try and keep it under 15 minutes. We're going to hit that 16-minute mark in this episode. But we did cover some 5 big retirement planning mistakes. Not having a plan for your taxes, that's a big mistake. Not understanding the benefits of tax diversification and where you could have money in your different investment accounts, that's also a big mistake. Also a big mistake is not taking full advantage of the benefits that your employer offers you. Our 4th mistake is relying too much on Social Security benefits. Yes, we're going to get something from it, but we can't have it be most of the income that we have, nor can we frankly assume that our Congress people are going to do a good enough job to stabilize the system. And then our last biggest mistake is cashing out your 401k or your traditional IRA early, paying a tax penalty, pushing you up into that higher tax bracket. So that's all the mistakes. Those are 5 really big mistakes I want you to avoid. If you want to learn more, especially if you want to see if you are ready to retire, I want you to download my retirement readiness worksheet, which you can get at retirementworksheets.com. Again, it's retirementworksheets.com, and then click on retirement readiness, and that'll go over all the things that you need to do to make sure you're ready to retire. Thanks again for listening. I appreciate you being here, and I will see you next week. Bye.
Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.